Andrew Bell, he's a European strategist with Rensburg Shepherds. And in Hong Kong, Darius Kowalczyk, he's a chief investment strategist at CFC Seymour. Andrew, I'd like to start with you. Horrible January.
Yes.
We could call it perhaps our international nightmare.
Yeah.
When does it look like it's going to be over, and what can we expect here?
Well, until January, actually, it was surprising how little equities in aggregate had fallen back, given the gathering gloom about economic growth and given the turmoil we've seen in the credit markets. Some bits of the equity markets have been hit, like financials and cyclicals, but by and large, things had held up. And I think January was the time when things caught up. And I think it's also a time when some of the building blocks necessary to limit the size of any growth slowdown or recession or prevent a general collapse of confidence becoming a self-fulfilling prophecy, those bricks, I think, fell into place. They're not all there yet, but I think it's much more possible to be optimistic about a soft hard landing or a hard soft landing than a complete descent into recession than it was 2 weeks ago.
Darius, let me put that to you. Can we be optimistic if we do get a slightly stronger jobs report today?
As far as today, I'm very optimistic. I think that payrolls will gain 105, which is 50% more than consensus. And I also expect a small decline in the unemployment rate. So stocks should rise today, the dollar should gain, and the yields should move higher as well. But this is only a short-term issue. And for the rest of the quarter and possibly the beginning of the second quarter, I think the trend will continue to be downwards because we haven't seen all of the bank write-downs yet, and because investors will continue to be concerned about how far the U.S. economy will slow.
What do you think, Andrew? Because, I mean, yesterday, you know, this week, we sort of, the issue of the monolines seemed to have been far greater than the Fed cutting rates, and we initially went down, and then MBI came out and said yesterday that oh, we're better, and so we rallied again.
It's a bit bizarre, you know. No, we're not bankrupt. Oh, that's all right then. You know, I think there are three things that have to fall into place. One is the cost of capital, cost of borrowing has to come down because the availability has tightened up. The second is the blood vessels of the financial system have got to become unclogged, and the sorting out some sort of recapitalization of the monolines is part of that. And the third is demand supporting measures, whether it be tax cuts, whether it be a drop back in the oil price. And unfortunately, the only country which so far has talked about cutting taxes is the US. And all that, though that might help demand in the short term, it's not going to help the world economy rebalance coming out of this.
Well, you mentioned the energy prices. So I'm going to get more from Andrew and Darius in a few moments' time. Let's just head out to OPEC, though, because Steve is there at the Vienna meeting to tell us what we're expecting today, which is not a lot, presumably, Steve.
Well, you never know, Ross. I mean, at the end of the day, let's just remember one pertinent fact. What OPEC says and what OPEC does are two completely different things. For instance, the Saudis are supposed to be pumping out 8.8 to 8.9 million barrels a day. They're actually pumping out around about 400,000 to 500,000 barrels a day extra. So they could actually put a production hike, an official hike, into the system and actually not affect the levels they're actually pumping the stuff out of the ground anyway. So you never know. There might be some form of symbolism to appease the likes of the IEA, to appease the likes of Samuel Bodman, who's pleading for more oil for the United States. But OPEC believes it's not about supply. They believe it's about the speculators, and they are very concerned at this time of the year that it's going to get warmer, that there'll be less of a desire for heating oil, there'll be less of a desire for crude because of the maintenance schedule, and as such they think by the second quarter the world will need 1.5 million barrels of oil less per day, which of course means that less of that 32 million barrels a day which is being produced is going to be needed anyway. Let us also remember one pertinent fact. OPEC is producing more oil than it has done since November 2006. You've got more Iraqi oil, you've got Angolan oil, all kinds of oil coming onto the market. The world, according to OPEC, doesn't appear short of supply. Back to you.
Steve, thanks very much indeed for that. Darius, just get your thought here. I mean, how much has high energy prices sort of been crimped at all in Asia? You look at economies like Korea and Japan.
In those two countries, there must have been some negative impact on the consumer because of the increased share of spending that goes into energy. But many other countries in Asia subsidize oil products to a large degree, which is sheltering the consumer there from the negative impact of higher prices in global markets. So overall, I think that the impact has been muted so far on the consumer spending and on growth in the region. It's the developments in Europe and in the US that are of much bigger concern.
Darius, hi, this is Christine here in Asia. We've got this breaking story. Chinalco and Alcoa apparently teaming up to buy a 12% stake of Rio Tinto. Now, we know for a long time the Chinese steel makers were worried about a spike in iron ore prices given the potential merger between BHP and Rio Tinto. Is this particular move simply a way to block any takeover coming from BHP?
This move is huge and symbolic. One of the purposes is definitely to try and impact what's going to happen in the talks between BHP and Rio, or in the attempted takeover. And the takeover now seems less likely, or the position will allow the Chinese to make some money of it. But also, China has long tried to secure commodity resources around the world, and this is a major step in that direction. Finally, it will relieve some of the balance of payments pressure on China, because presumably there will be an outflow of currency from the country. So, you know, it's a sign of times that the Chinese are doing this kind of deals, and it is helping them on several fronts.
You know, Darius, it's interesting because this takes place at a time when Australia has a new prime minister, which has close links with the Chinese. Do you think it's any coincidence here?
In this case, I think it is a coincidence, because China was sort of forced by fear that its steel producers will have to deal with a lower number of iron ore suppliers, which would be very disadvantageous for Chinese buyers of this commodity. But definitely it helps for the political fallouts from the deal that the new prime minister in Australia is much more sympathetic to the Chinese, and much more involved in Asia than his predecessor was.
Yeah, Andrew, I mean, you take a look at this today. No surprise to see Rio stock bouncing up. And basic resources are the top sector today. What do you think of this sector from here, and the implications of this story for wider investment?
I'm still a bull of the mining story, because I think, well, twofold. One, I don't think we're going to have a hard crash landing in the Western economies, and two, I think that the growth story from the emerging giant economies of Asia is going to continue to be very commodity intensive. We're going to see a lot more of countries, particularly such as China, trying to buy some sort of share in commodity stocks. It's probably too controversial, or it's more controversial, obviously, to take outright control of a company, but this is a way of their gaining some exposure to things which their economy is very dependent on. It's also why there are, you know, anecdotally, there are hundreds of thousands of Chinese engineers working on various mining projects in Africa. They're trying to buy influence in areas which are critical to the health of their economy.
Darius, Christine here. What are you buying in this particular times? I mean, what sectors are you looking at?
I think that we have to look at the defensive sectors, because even though Asia is going to continue to see strong growth despite what's happening in the US, capital markets are very correlated, and I believe that the US stock market will go down, which will drag down the whole world of equities. So the defensive sectors will be the most likely to be on a relative basis the safest. Among countries in Asia, I think China, after the new year, will see a rebound. The drop since the peak last year was quite dramatic, and it was partly caused by the recent snow storms, which stranded a lot of potential investors who have no appetite to think about new purchases. And I think after the new year in China, we are going to see a rally in the stock market there.
All right, Darius, we're going to leave it on that note. Thanks so much for joining us. Darius Kowalczyk, Chief Investment Strategist at CFC Seymour, and Andrew Bell, thank you as well. Andrew Bell is a European strategist at Rendsburg Shepherds. Christine.